Good morning and welcome to the CT Automotive Group PLC investor presentation. Throughout this recorded meeting, investors will be in listen-only mode. Questions are encouraged. It could be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Simon Phillips, CEO. Good morning, sir.
Good morning, everyone, and thank you for joining us today. So I'm Simon Phillips. I'm the CEO and founder of CT Automotive, and with me is Anna Brown, our CFO. So firstly, to give you a little bit of background about the company for those investors that don't already know CT Automotive. CT Automotive is an interior business specializing in kinematic parts, illumination electronics, actuators, and decorative finishes. Our product range includes things that you see in the car, like things like air vents, armrests, deployable cup holders, in-car mood lighting, and panel finishes. So what you can see from the first slide is our customer base, and they're well-recognized brands. You know, people like Ford, GM, Nissan, Volkswagen, Audi Group, Honda, Tesla, Rivian, Stellantis, and we even work with a lot of premium brands like people like Bentley and Lamborghini. The business itself can really be sort of characterized by what I would say is high barriers to entry, limited competition, and high technical expertise. It also has long-term revenue streams and protected margins. So before COVID, in the 10 years run up to
Simon, sorry, just seem to have lost your audio there ever so slightly.
Okay, is it?
There we go, you're back now. That's great, thank you.
Apologies, everyone. I'm coming from an office in Pune, so the Wi-Fi can be a little bit difficult. So one important thing to understand about the business is our product uniqueness. So our products are unique to each vehicle, and we're the only global supplier that once launched into production, we get revenue streams typically last 6 years, providing the business with excellent visibility into our forward revenue streams. Margins in the business are maintained through open book costings with our customers. Revenue streams come from two forms. One initially is the ED&D contracts for design and development, which include things like tooling, production lines, etc. And then thereafter is the ongoing production revenue. The split ratio in terms of top line turnover is ED&D to production is approximately sort of 1:12. In terms of our manufacturing sort of footprint, so we have a global presence. Our manufacturing plants are generally located in low-cost regions of the world, so that's regions like China, Mexico, and Turkey. We also have distribution centres. Those distribution centres are in the UK, the Czech Republic, Spain, Detroit, and Tokyo. And the purpose of the distribution centres is for us to provide just-in-time delivery into our OEM customer base. The nature of the business that we operate in is always to find better cost benefits for the company to become more efficient. And one of the things that we're doing at the moment is our administration and design functions are led out of our office in Pune, India, which is where I'm coming to you today from. And that helps further reduce our fixed cost base. Growth drivers. So growth in the business is driven by our efficiency and innovation in design and production techniques compared to our competitors, thereby offering low cost prices and the ability then by producing technically advanced products at low costs gives us the opportunity to grow into the market share of the OEMs that you've already seen. In terms of geographical distribution of the revenue that you see on the top line, so our sales revenue is approximately coming 50% from Europe, 40% from the USA, and 10% from Asia. Another factor that's helping us really in terms of general growth is that for most of you guys who are driving cars, you constantly see this increase of the quality of interior content in vehicles. And what we're generally seeing as platforms change from one model to the next is a general increase in dollar value, let's say, per platform that we operate in. So at this point, what we'll do is we'll move on to the investor presentation. I hope that that's given you a bit of background about the business itself. So Anna, if you could take the next slide.
Thank you, Simon. Hello, everyone. I'm Anna Brown. I'm the CFO of CT Automotive. So I'll take you through the financial highlights first. So as you can see, looking at all of our financial metrics, we have improved in 2023 compared to 2022 across all of our metrics. As our markets reopened in 2023, that helped us to grow revenue up by 15% to 143 million in 2023. The gross profit in absolute terms has almost doubled or more than doubled to 30.9 million. And that really was due to benefiting from reopened markets, but also stabilizing direct labor and material costs. And importantly, our ability to execute margin improvement initiatives, particularly in the second half of 2023. Our underlying EBITDA has also improved from a loss position of 7.1 million to a profit of 16.1, again benefiting from all the improvements at the gross profit level, but also benefiting from normalized container rates and more stringent discipline around foreign exchange. Our underlying PBT improved to 8.3 million from a loss position of 14.5 million in 2022. Again, benefiting from all the kind of factors which I have already explained at the gross profit and underlying EBITDA level. We had a strong EBITDA conversion rate to cash of 59%. And also we have successfully reduced our net debt from 12.2 million to 13.8 million at the end of 2023, which benefited from the fundraise, which took place midway through 2023, but also through our ability to generate operating cash in the business. At this point, I will hand over to Simon to cover some operational highlights.
Okay, so to take you through some of the operational highlights that we saw in 23. The operations in China did really great following what was an awful situation of enforced lockdowns in the previous year. Turkey managed the inflation effectively, and Mexico performed as expected post startup of what is our new manufacturing plant. We streamlined our operations by closing what was an unprofitable facility in the UK. A key focus for us throughout 2023 was the implementation and the execution of automation across our facilities, which significantly enhanced our production efficiency and reduced our costs, as will be seen in the gross profit margin later. Additionally, we expanded our India office, which is quickly becoming what I would say is the nerve center of CT Automotive, providing critical support, driving our global operations, and also reducing the overhead costs of the business. We also relocated some production to Guangzhou from our Shenzhen facility, which gives us a situation where the labour costs are more competitive there. But also in Guangzhou, we've got higher levels of automation, which resulted in improving our gross margins and driving efficiency as well. Moreover, we launched numerous different platforms and programs throughout 23. I suppose most notably was the 710 forward program out of our Turkey facility, which helped assist in driving that revenue higher. The efficiencies achieved in 2023 will annualize into 2024, really the jump-off point of 23. And we are actively working as we speak to further improve those gross profit margins to yield a better result in 24. At this point, I'll pass you back to Anna so she can take you through the income statement.
Thank you, Simon. So let's take you through some of the key financial performance aspects. So looking at the income statement, as I have already mentioned, the revenue has grown by 15% to 143 million. And as you can see, the growth came both from serial production, which went up to 132 million, but also from tooling, which contributed 11 million in 2023 revenue, and that was down to a high number of projects which were delivered in 2023. So gross profit, as I already mentioned, benefited from normalized market conditions, more stable direct labor and materials, but also the execution of our margin improvement initiatives during the second half of 2023, which meant that in absolute terms, gross profit has more than doubled to 30.9 million, which also resulted in an improvement in our gross profit margin to 21.6% compared to 12% last year. We also successfully reduced our operating expenses. This was down to, first of all, lower container rates, which went down from almost $13,000 per container in 2022 down to $6,000 in 23. We've also deployed some initiatives in terms of right-sizing our overhead base, and also more stringent discipline around how we manage our foreign exchange exposure, which meant that our underlying EBITDA increased to 16.1 million. Our depreciation and amortization remained at very similar levels to 2022 at 5.3 million. We have incurred 2.4 million of non-recurring items, and after taking account of all of this, the operating profit settled at 8.4 million in 2023, which is a significant improvement compared to a loss of 16.8 million in 2022. After finance costs of 2.5 million, the profit before tax for the year settled at 5.9 million, and after taking account non-recurring items, underlying profit before tax resulted in 8.3 million profit compared to 14.5 million loss last year. We would now like to take you through some of the key bridges. First of all, it's revenue bridge, which shows the key building blocks of revenue growth by 15%. So first of all, tooling division has delivered 3.9 million additional revenue in 2023, and that was down to delivering more tooling projects. We've delivered 15 tooling projects in 2023 compared to 12 in 2022. And then you can also see that our production facilities in China, Turkey, and Mexico have all been growing during 2023 and contributed overall 14.8 million in terms of revenue increase. Looking at specifically at the programs, so 52 programs were recurring. These are those programs which started production before 2022, and they delivered 9.2 additional revenue in 2023. We've also launched 4 new programs which started in 2023 and contributed additional 3 million revenue. And one particular program is worth mentioning because it's quite significant. 6.8 million were generated, additional 6.8 million generated from P33A, which is a program for Marelli Nissan, which started during 2022. Looking at the gross profit margin bridge, so here are the key components which show the progression from 12% gross profit margin in 22 up to 21.6% in 2023. Tooling division has contributed 1.6 percentage points. Material cost savings delivered 2.7 percentage point improvement, and that was down to normalizing material supply, but also the work which we have done to rationalize and restructure our distribution, our supply chain. And in terms of the labor cost savings, these contributed 5.5 percentage points, and the key drivers, as we have already mentioned, were normalized labor conditions in 2023, reduced headcount primarily in China, introduction of automation and robotics towards the second half of 2023, and also relocation of some of our production programs from Shenzhen to Guangzhou facility in China, which benefits from lower labor cost. Underlying EBITDA bridge is showing the key building blocks in terms of the improvement of EBITDA from 7.1 million loss in 2023 up to 16.1 million profit. As you can see, in absolute terms, tooling has contributed at the gross profit level 3.8 million, serial production 12.2 million, and within that 6.1 million came from labor cost savings, 3.1 million came from material cost savings, and 3 million were contributed from margin on additional sales. We also benefited from lower freight costs. 1.7 million contributed towards the EBITDA improvement as a result of lower freight, and also the work which we have done in terms of rationalizing our distribution and distribution and logistics chain. We have introduced more stringent controls and discipline around managing our foreign exchange exposure. In 2022, we've incurred a foreign exchange loss of 3.8 million, but in 2023, we've managed to contain that volatility and generated a 0.9 million profit, 0.9 million foreign exchange gain. And admin headcount cost reduction contributed 0.9 million towards the EBITDA improvement. Looking at net debt, that has significantly improved from 12.2 million at the end of 2022 down to 3.8 million in 2023. The key components were our ability to generate operating cash flow, and that was 8 million. We also spent 3.2 million on capex, 5.5 million on repayment of lease liabilities and interest on our working capital facilities. And we also benefited from the fundraise, which took place mid-May last year, which contributed 9.1 million net of transaction costs. At this point, I will hand you over back to Simon.
Thanks, Anna. So first of all, let's look at a review of our key operations in China. So our operations in China have been a significant contributor to our overall success in 2023. China contributed roughly about 106.7 million to our revenue, and that was really driven by a strong recovery in demand post-COVID. We capitalized post-COVID on enforced lockdowns by ramping up production and improving efficiency, which played a critical role in the revenue growth that you've seen. The strategic relocation of production to Guangzhou further enhanced our operational efficiencies, contributing significantly to our gross profit margin bridge that Anna showed earlier. Focused on improvements in our ERP systems has given us improved efficiency and headcount overhead reductions. Our focus on automation and cost management in China has resulted in a substantial labor cost saving, which again was a key driver to our improved EBITDA. Our operations in China, you could say, have thrived really since the recovery of post-COVID, and that's really sort of showcasing the resilience and the strategic capability of our business within that region. So progress on material improvement or margin improvements. So as you've seen from the EBITDA bridge, we've made substantial progress in our margin improvement initiatives throughout 2023. Automation has been, I would say, the cornerstone of that strategy, significantly sort of enhancing our production efficiency and reducing our labor costs. Strategic relocation, such as moving production to Guangzhou, has further contributed to the cost savings and that operational efficiency. I'd say our robust cost control measures have driven significant savings in materials and logistics, and that's resulting in a notable increase in our gross profit margin from 12% to 21.6%. But at this point, I would say it's definitely worth noting again that 70% of our PBT was created in the second 6 months of the year. So as you can imagine from that, our gross profit margin jump-off point was at a higher level in the fourth quarter than the average that you saw of 21.6%. These improvements are not just a one-time gain. They set a strong foundation for the continued margin enhancement into 2024 and beyond. So a review of the operations in Turkey and Mexico. Our Turkey operations contributed about 15.6 million in revenue, and despite facing the hyperinflation pressure that we saw in 23, our team effectively managed the costs and maintained stability. We implemented robust financial controls to mitigate the impact of hyperinflation, ensuring that our operations remained profitable. In Mexico, our post-startup performance has been quite impressive, contributing 9.7 million in revenue. But one thing worth considering in Mexico at the moment, 9.7 million revenue is really just covering our costs. Mexico has been set up to gear up to $30 or $40 million, which will start to play out in 25. The successful ramp-up of the new programs in Mexico has been a key driver of this performance, highlighting our ability to quickly adapt and optimize to new operations in a different location of the world. Both Turkey and Mexico have demonstrated strong operational performances, contributing significantly to our overall success in 24. So talking about revenue visibility and our new business pipeline. So we have strong revenue visibility going forward, supported by a solid pipeline of new business opportunities. Our long-term contracts are recurring revenue streams provided by stable foundations for future growth. We are actively pursuing new projects and partnerships, which are expected to drive additional revenue growth in the coming few years. Our strategic focus on expanding our customer base and entering new markets will further enhance. So overall,
Simon, I do apologise. I think we just had a dip in your connection there. We just lost the last few seconds of that.
Okay, can you hear me okay
yes,
now?
Absolutely, sir. Thank you.
Okay. So just going on to the outlook then. So looking ahead, we're very optimistic about the continued growth and success of CT Automotive. I think, historically we've had a very good track record for that, both in terms of growth, margins and profitability. Sadly disrupted during the COVID period, but we strongly believe we're back on target now. The margin improvement achieved in 2023 will continue to benefit us into 24, with further operation enhancements expected and currently being worked on right now. We are in advanced negotiations for a new debt facility, which will provide us with additional financial flexibility moving into the future. Our focus on innovation and efficiency and expanding our market presence positions us, we believe, very well for 24 and beyond. So we're confident in our ability to meet market expectations for 24, as we've done in 23, and we have a positive outlook for 25 and beyond, driven by the strategic initiatives and strong execution capabilities that you've been able to witness in 23. Just as a sort of final thing to say, Anna and I are extremely proud of the team efforts, resulting in a 70% PBT generation in the second half of this year, post fundraising, and our ability to unlock our chance to be able to drive those margins. We've implemented robust systems to prevent future underlying issues and made significant technical accounting adjustments to mitigate FX going forwards. Our financial bridge highlights key improvements in turnover and EBITDA, executed very efficiently by the management team. And just on a very last note, I think what we would like to do is we would like to thank our investors for their vote of confidence in the fundraise, and our customers for their unwavering support during the COVID period, which clearly was, a very historically difficult time for the business. So on this point, I'd like to pass you back so we can start opening up for some of your questions.
Fantastic, Simon, Anna, thank you very much indeed for the presentation. Ladies and gentlemen, Simon said, please do continue to submit your questions just using the Q&A tab on the right-hand side. To click Q&A, scroll to the bottom, type your question and press send. Just while the team take a few moments to review those questions submitted today, I'd like to remind you that recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Simon, Anna, I'm going to just bring your cameras back up, and Simon, if we do get a dip in your connection, we'll switch it off just to keep that audio integrity. Look, we've received a number of questions, both pre-submitted and throughout today's presentation. If I may just start off with the first question that we've got here. It reads as follows: new business was obviously strong in 2023. How's the new business pipeline developed in 2024?
So, looking into 24 at the moment, we have got one of the strongest, I'd say, new business pipelines I've known, certainly in the period of time that running the business from being a founder. To give you some sort of examples, the back end of 24 Q4, we're launching a number of new programs, which include things like Ford Puma, Lincoln Navigator, Ford Explorer, Honda Prologue, Ford Expedition, some additional content on Duke, GM, but through the BEV3 van that they have. Iveco, they're launching a new range of the trucks that they have down in Spain, and we've picked up additional content on Rivian R1. So between all of those programs, what it really means is that we're not going to see a huge amount of that revenue coming in 24, but going into 25, it puts us in a very strong position.
Fantastic, thank you very much indeed. Next question we've got here: when you win a new program for a car manufacturer, how long does the work typically last for?
So, the normal car platform process really works like this: that cars are launched, they typically last for about 6 years, then tends to be a sort of a mid-model year cycle facelift, which often results in us being able to generate some more ED&D revenue as the OEMs try and spruce up the interiors of their cars. But the good thing is that this sort of 6-year revenue stream that we have from car platforms gives us very good forward visibility of our earnings, both not just from product components, but also from tooling, because tooling and ED&D is developed normally about 2 years in advance of car launches. So what that means in terms of our forecasting for 24 and 25, we've got for 24, you could say we've already locked down our expectations for revenue on ED&D, and the forecast looks good. The customer schedules are normally firm for quite a few months in advance. We're already midway through this year, so we're pretty confident about 24.
Fantastic, that's good to hear. Another one we've got here is: how key looking forward is robotics to your business, and how quickly can you generate a return for that investment? Okay,
so technology is moving on extremely fast at the moment, and we're deploying it. And really one of the strategic advantages, I guess, we have as a business is that we are in Shenzhen, and Shenzhen, China, is probably the technological hub of the world right now with regards to robotization, automation of production plants, and also to a certain extent a level of AI and the deployment of AI. So from robotics, we see it as a key factor. The cost point of robotics have come down to a point where we can see return on capitals in a year and a half, 2 years. With regards to further reducing labour costs, we're starting to deploy things like AI on vision systems. So I think it's just becoming one of the key factors for our business, not only to allow us to be more cost competitive, but also to allow us to build better quality products more reliably, more consistently.
That's great, thank you. As you can see as well, guys, we've had a number of live questions come through. If you wouldn't mind just clicking on that Q&A tab and just, where appropriate to do so, read out the question and give you a response, and we'll pick up from you at the end.
So we have one question in relation to cost price increases built into the contracts to insulate from inflation. So Simon, do you want to answer?
So this kind of varies in different parts around the world. But if you take, for example, Turkey, for example, where obviously the country's been subjected to quite significant hyperinflation, the OEMs that we deal with, the way that they've overcome that is that we run escalation system models where the escalator is almost like split into two halves. One half deals with currency of imported materials. The other half is really dealing with the cost base within Turkey with regards to Turkish lira and the hyperinflation that's going on in that part of the world. So the purpose of the escalation system is to ensure that we get stability of margins, and that has been working very well. I mean, with regards to other regions of the world, we tend to work on an open book costings with our customers. So what that effectively does is that if costs go up, then we enter negotiations with our customers on materials, things like freight costs, and that's generally been passed through quite successfully. But it's a double-edged sword because, you know, if costs come down, then our customers are on to us and they expect the associated cost reduction. I think the important thing for us as a business is to really ensure stability within the margins that we have.
Okay. Then that probably also partially answers the question, with a large percentage of production from China, what is the strategy for geographic diversification, and does this impact margin?
Okay, so some thought process on that. I mean, the specific reason why we're in Turkey is that Turkey as a country has a very high expectation of built-in content locally produced within their OEM base. So Turkey is there specifically for that reason. I think, you know, there are geopolitical tensions, and these geopolitical tensions, you know, led to the Trump tariff of 25% from China to America. So the reaction from us was to really use all of the skills base that we've learned in China to be able to shift production facilities on what is our modular production systems that we do, to be able to rapidly set up and deploy new production in Mexico to deliver into North America. And what we're seeing there really is similar sort of gross profit margins to what we're making out of China. But as it stands at the moment, you know, China continues to be really good for us from a perspective of leading edge manufacturing capability and technology, and also a good supply platform into Europe as it stands right now. And that's really the main sort of focus of China is shifting product into Southeast Asia and into Europe.
There's a question here around the revenue visibility through to 2030 on the back of the tenders won in 2023.
I mean, just to answer that, really, I mean, as a business, you go through product life cycles when you have 6-year cycles and then renewal of contracts. I would say that the business has been extremely successful of running ongoing contracts. I mean, examples of which is that, for example, in Turkey, we've been producing Ford Transit van over there now for the last 14 years and winning every consistent new contracts coming up. If you look at, say, what's Nissan Europe, I think we're now on our 3rd generation of Qashqai and Duke, and we should be going into in fact, we've already been working with deals with Morelli, who's one of our best and largest customers, where we're securing the future now all the way out to 2032. So in terms of the product life cycle of our business, they're largely refreshed, and the ones that really aren't refreshed, we're almost at the point of just agreeing the contracts out to 2032.
So we've got a couple more questions, but they're also about the revenue going forward and pipeline. So hopefully we have responded to these questions already.
Fantastic. Thank you very much indeed. And of course, any further questions that do come through, the team will be able to review those and be able to publish responses where appropriate to do so on the Investor Meet Company platform. Before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Simon, perhaps I could just ask you for a few closing comments, please.
Yeah, I would just like to, I guess, say that, this is a business with a history of doing exceptionally well prior to COVID. COVID it hit the auto industry hard. I'd say it hit us particularly hard, given the fact that we do a lot of manufacturing in China, and obviously China went into zero COVID when the rest of the world had recovered. But we believe we're back on a very strong trajectory, as we have been historically ever since. And if any final comments from my side, would just simply to again thank our team at CT for what was an incredible execution over that period of time, and also without a doubt to thank our customers and in particular Morelli, who were incredibly supportive for what was a very difficult time.
Fantastic. Simon, Anna, thanks indeed for updating investors today. Can I please ask investors not to close the session? It should be automatically redirected to provide your feedback in order the team can better understand your views and expectations. It's only taken a few moments to complete, and I know it's greatly valued by the company. On behalf of the management team of CT Automotive Group PLC, we'd like to thank you for attending today's presentation. That concludes today's session, and good morning to you all.
Thank you.